Hi, everyone. This is Kalia from Marcus Evans. Thank you so much for joining us today on this webinar on the future of alternatives, real estate access, innovation, and opportunity. This is in partnership with the Sterling Group. Before we begin, I'd like to cover just a few housekeeping items. As you can see at the bottom of your screen are multiple application widgets. They're resizable and movable, so you can move them around to get the most out of your desktop space. I'd like to encourage you to submit any questions that you might have by using the Q&A widget, and we'll try to answer as many as possible throughout the broadcast. However, if a full answer is needed or we perhaps run out of time, make sure to send you an email afterwards. I'd also like to draw your attention to the resource list that will contain a copy of today's slide deck, and please bookmark any links that you might find useful. To answer any common technical issues, I advise you use the help widget. And finally, a reminder to look out for an email in the next 2 hours with links to review today's session. At this point, I'm pleased to introduce you to our moderator and our host. We have with us Lance Swank, who is the President and CEO at the Sterling Group. Very happy to have you on, Lance. I'm going to hand it over to you, and I hope you enjoy it.
Very good. Kyle, thank you very much for that. Thank you for getting things set up. Welcome to the webinar. I think you'll find at least some very interesting conversation and Q&A at the end. But again, if you would, please include some questions you may have in the question chat, and we will get to it at the end of the webinar. To start with, I'd like to introduce the panel. Todd, you want to lead off, please?
Sure. I am Todd Schoenberger. I am the CIO of Single Family Office Crosscheck Management, and I also oversee the media division for the family office.
Excellent. Jeff?
My name is Jeff Myers. I'm Director of Private Markets at Archbridge Family Office, a St. Louis, Missouri-based multifamily office.
And Steve, please.
Thanks, Lance. I'm Steve Canner. I'm the founder and CEO of S2K. What we do is we distribute product to financial advisors trying to solve for their needs and wants. And also we are a sponsor of product as well to that channel.
Well, and as Kyle said, I'm the President and CEO of the Sterling Group. My name is Lance Swank. Just very briefly, Sterling is a vertically integrated investment manager specializing in multifamily housing and self-storage in the United States. We're involved in 11 states, have 10,000 apartment units and over 2.5 million square feet of storage, and really enjoy engaging with our investors and building new relationships. We hope that you enjoy the webinar today, and any of us are available for follow-up at your leisure. Our contact information will be available, I believe, in the resource page. Okay, well, without any further ado, I'd like to get started and provide some great content for you. But we do have a couple poll questions that we would like you to entertain and respond to, if you would. We really want to try and understand who the audience is. As you can see, the first one is, do you, your advisors, currently include private real estate offerings as a part of your clients' portfolios? So I'll give you a moment to answer the question. And as you can see, we have a pretty mixed group, which is excellent. And so we will tailor our remarks accordingly. Thank you very much. Well, to honor the time we have, we'd like to jump right in with our first panel question. As you can see, it's access and democratization. What does broader retail access to alternatives really mean for family offices, RIAs, and high net worth investors? And how should the industry adapt? Steve, would you like to start us off here?
Sure, thanks, Lance. Well, if you look at portfolios for institutions, they're weighted much more heavily to real estate and alternatives than most portfolios are, and the reason is that a lot of people today want to figure out how do you diversify away from the stock market. And so our job at the end of the day is to try to help create product that really serves a need for the retail consumer. That could be they need yield product, they need cash flow to live their daily life, or it could mean they have tax considerations they're trying to deal with, where they can either move taxes out or not pay taxes at all. Those are the main places that real estate comes into play for a lot of people and consumers that they haven't really seen in the past. But more products being done, and the way it's being done is through these offerings that are being done that they can invest in a piece of a product. They don't have to own the whole building, and it makes it a lot easier to own a piece of a product with hopefully what I call the best sponsors. And I do believe over time the best sponsors like yourself, Lance, are going to come to the marketplace and bring that to the retail consumer.
Thank you, Steve. I appreciate those comments. Todd, would you like to take a stab at responding?
Yeah, the question really comes out to be about democratization that you hear a lot about in finance circles now. So it does open up liquidity pools, of course. It gives family offices and others more opportunity for deals. So you would hope that with more, especially also creating more feeder programs, I believe is what Steve was alluding to. So you definitely want to take a look at that entire picture, because you have so many other funnels of money that are coming in looking for more deals and opportunities that exist. And I think it's really, you turn to a Sterling, for example, and see how you can incorporate that management side as far as maybe taking some of that cash and putting those investable dollars into those types of programs.
Yeah, Jeff, do you agree with that? And maybe you have some comments to expand.
Yeah, I think it's really interesting how this is sort of the untapped or freshly tapped sort of pool of capital, as Todd mentioned, that is going to drive a lot more opportunity and a lot more capital into the space. And I think the thing that this draws out is more scrutiny. It's going to require more from family offices, professional investors, and advisors to have a better sense of what they're looking for in the market and how to find access to that. With sort of a broader pool of capital, of more democratization, more access to these investments that maybe historically have not been as accessible for the broader retail market, it's going to present opportunities that are going to have to be more highly scrutinized. Having a professional investor or advisor sort of advising either the client specifically or the portfolio construction as to what they're looking for is going to become a critical component here. It should have been part of the conversation to begin with, but now it's going to require just more understanding of what you're looking for and where the investor wants to go within this market. As we see more capital flow in, the access points will become just more wider, and the deal flow will increase, and it could lead to compression of returns. It could lead to potentially deals that maybe aren't the best fit for everyone, but are going to be showed to everyone. And so there's going to be a lot more requirement for investors to know what they're looking for and to have sort of an understanding of what makes sense for them and where they want to go, instead of just broadly accessing all of it.
I agree with everybody's comments, and really, Jeff, your comments resonate with some of my optimism and concerns. I think from a sponsor standpoint, we're thrilled that there'll be a dissemination of the ability to show people offerings. But from an investor standpoint, it can lead to some confusion. I think it's wonderful that these private investment vehicles will be broadly accessed rather than held by a few. But I think the focus on sponsorship is going to be critical. The focus on due diligence materials is going to be even more critical, so that investors can look for transparent underwriting and of both the sponsor and the investment vehicle. So I know we're going to talk a little more in a later question about that, but with this proliferation and democratization, I think there's going to be a need for some disciplined evaluation of these many offerings that will be out there. So great discussion, and look forward to any questions from the audience regarding this. We have a follow-up poll question. Now that we know we have kind of a mixed group, What is your biggest challenge in the adaptation of including private real estate offerings? And I'll let you read this for a moment and respond accordingly. Obviously, unfamiliarity, lack of due diligence, lack of access, or other. Okay, pretty clear. And that helps us a great deal. Well, I think the democratization certainly is going to help that, and will make things much more accessible. Let's move to our second question and reflect on the 100% response ratio to that question as we're responding. This question, obviously, tech and innovation. How are fintech platforms changing discovery, due diligence, and ongoing management of alternative investments? What efficiencies, risks are emerging? Fits right in with that poll question. And I think, Jeff, if you'd like to start us off on this, I'd appreciate it.
Yeah, it's pretty amazing how, in general, all areas of the market get impacted in some way by technology and the innovation that drives that. And it's really impressive to see all of these companies that have come to sort of target this area. As we've seen democratization and rise of potential access to more investors to these investment opportunities, fintech is right behind it and sort of solidifying and facilitating that access. We've seen a number of sort of companies that have created these platforms where either advisors can access deals that potentially weren't accessible before to them, or even direct to consumer, sort of the client itself themselves can access these opportunities, and they kind of package everything for you. We've seen a number of these opportunities where the deal is brought directly to the platform, and a few simple clicks, you can access the opportunity. You can read and review the diligence package that's been created by the platform. They're sort of combining all aspects of the investor sort of professional aspect into one simple to use technology platform. And then it sort of changes your underwriting approach from that perspective. Now you have to know, are you comfortable with that platform's approach and the way that they underwrite deals? But most of them have backing from sort of larger consultants. And you can see sort of a fully baked package available to you as advisors and investors to access these opportunities. It's highly efficient. You can, in a few clicks, access a very large real estate opportunity that maybe you would never have heard about if you didn't look here, and you might be able to participate at a lower minimum threshold than is typically associated with these investments. It changes the landscape, right? It changes the risks and the metrics that you need to sort of be aware of and look at, but it provides the access that many don't currently have.
Yeah, I couldn't agree more. I think those are all excellent points. And Todd, do you want to talk about this a bit and maybe add?
Yeah, absolutely. Well, I mean, with fintech, look at it like a scalpel to cut costs. Definitely improves efficiency, as Jeff was speaking of, and it can improve speed actually as well. The risks, though, there is a risk. I'll add to that, to everything that Jeff said. The risk is you're going to have crowding. You might have these black box deals that just are standard. You really need to have that. That's the only thing. It's great to improve speed and take care of due diligence and KYC and AML stuff. But at the end of the day, you still have to start looking at which deals are going to be able to optimize returns. And the problem with cutting costs is that sometimes it's a sledgehammer at actually taking away some of the maximizing total returns in the long run. So that's the only issue. So when you go down this path and you start to streamline that process, you want to weigh the risks and the returns that are there. I know that's what we do.
Yeah, excellent viewpoint. It's a way to add to it. And I think certainly it puts a lot of emphasis on track record of both sponsor vehicles. Steve?
Yeah, Lance, I was going down that, which is the informational flow is easier, but real estate's a local business, right? And it's a real local business. You could be in the
Yeah.
same area, two street corners could be different, right? So at the end of the day, just because the information's there, you know, having the experts know what to do with that, unless, you know, if you live there, that's one thing. You know the corners, right? You know what's going on. You know the economics of what's going on in that town, where the jobs are, who's going in business, who's out of business, right? Here, I would tell you, be very careful. Be very careful. You'll have more access, but I would go back to what you were saying, Lance, which is make sure that the people you do business are people you want to do business. The sponsor, in my mind, is very important, and that fintech's not going to make them better or worse. The facts are the facts.
Yeah.
Yeah,
You need that human element.
What's that? Go ahead.
You need that human element.
Absolutely. Yeah. You know, fintech it's a game changer. You know, as you said very well, Jeff, these many platforms that are coming out are outstanding, but there's a proliferation of them. One that we use, I know Steve uses, is 1776ing, and I think it's excellent. It's robust. It's certainly not built to be a marketing machine, but it's certainly built to house great due diligence and a place to make it easy for a prospective investor to evaluate the opportunity or opportunities, buy sponsor, and seek deep information that you normally wouldn't see. In the old days, I say old days, 2 years ago, 5 years ago, and we would meet with people and present an investment summary and then ultimately a private placement memorandum for private investments. And it was more face-to-face, certainly than it is now. And so the ability to look in the barrel, I think, should be gauged by the amount of due diligence information that is available on those platforms. If there's not a lot of information, it should send up a red flag. If it's a brand new sponsor, it should require additional scrutiny because it's very easy to present prospective returns. It's another thing to have actually produced them. So great points, guys. I appreciate it. Yes, please.
And one more, Lance, one more thing. In 1776, for example, what it really does, in my mind, is it makes the execution, the paperwork, much easier, right? So the one thing about private placements is people do not like paperwork. This cuts that down. It doesn't get rid of it, but it makes it much more easier to execute and buy a private placement.
Steve, what is your 1776ing access? What is S2K?
So every one of our deals is on 1776. You can go on, you can see all the marketing, you can take financial advisors can take their tests, they can do whatever they have to do. It's all there. You can start the paperwork, stop, come back to it. It really makes it much easier. And the other thing that our site is it continues to grow in is that it really is a constant informational flow. So we have a project. You can go on that project and get on, and you can see what's going on with a camera there. Everything is housed in one place, so you can get on, do your homework, do your due diligence, get the documents you need, see a private placement memo, and execute a trade all in one place. It just makes it easier.
Yeah, we use the same platform, and I'm going to make a comment that I want to get some more feedback from Jeff and Todd. But ours is sterling.1776ing.com. It's basically the same platform Steve uses, but it's customized to our offerings. And like he said, it makes it very, very easy to flow through the evaluation process and even the investment process and accreditation process. The other nice thing is these platforms flow directly into the back office investor platforms that we have in-house to manage the investments for our investors, that houses all their documentation, whether it be reporting, or their subscription agreements, wherever it may be. Jeff, Todd, do you have a perspective on some of these platforms that you've utilized?
Well, the comment that I was going to make really quickly is that what's really nice, and we've highlighted here, is there are some platforms, like you've mentioned, 1776, that does everything for you. And then there are other platforms that handle just pieces of it. If you have your own sort of due diligence process that that really is, hopefully, like Lance mentioned, more face-to-face and requires a little more direct contact with the manager to sort of build your case. There are platforms out there that facilitate just the paperwork aspect of it. As we've talked about, PPMs and filling out these documents are difficult. And for advisors and clients, it can be something that's new and foreign to them. And to have a platform that, A, walks you through it, how to answer those questions and how to fill out that information is really beneficial. But B, can also connect to your CRM systems, whether that's a Salesforce or a Redtail or whatever's out there today, to auto-fill the information you're looking to put in manually. It can streamline that process immensely. And then even on the back end, the monitoring process as well, there are technology platforms set up purely just to take in the emails that are received, the updates that are received, and sort of provide you a dashboard overview of what's going on with that fund so that you have the ability to track it and rope it into your broader portfolio reporting piece. And I think that, like you mentioned, Lance, the proliferation of options here is really to the benefit of the investor. Of course, you've mentioned it to the sponsor as well, but specifically thinking from the investor perspective, I mean, it just levels up the operations side. You don't have to hire a very large team to manage this process anymore. You can streamline a lot of that through a technology solution that allows you to spend more time with your client and more time answering their questions and kind of giving them comfort in their investments, and less time on sort of the operational side that requires time and effort and diligence and sometimes a lot of manual effort.
Yeah,
Todd, do you see the same thing? Go ahead, Todd.
Yeah, and I'll add to that too. I mean, it's great that 1776 can do everything. It's an all-in-one system. However, we're not there yet, and we have to have that personal face-to-face. I mean, it's great to automate some of the paperwork, but at the end of the day, we still need to focus on due diligence, having that personal relationship, answering those questions that we need answered. That's what I feel that's where we are now. Now, perhaps 5 years from now, when the entire world is completely automated, we'll have a different stance. But currently, it's one thing to automate part of it, but at the end of the day, we still need to have the answers that are being verbally given to us.
I would say that if we look at the spectrum of investors, I think from an advisory standpoint, if I'm an advisor with a group of clients, this is revolutionary, because many times the advisors, A, don't have access to alts, and number two, when they do, they aren't certainly accessing sponsor or senior leadership representing those investments. As offices, you guys have a unique perspective and do have that access, and I'm with you. There's no substitute for the personal relationship side of this business. It's very, very meaningful. Guys, I'm going to move on to the next question. Excellent discussion. The next one here, obviously, is real estate focus. In today's market, what's driving interest in multifamily and self-storage? How should investors weigh valuations, cycle risk, and long-term demand drivers? I'll lead off on this one. Obviously, I live and breathe it every day. I would say that, there is significant opportunity in the multifamily space if you understand the analytics and look out past the doldrums. We've just come through an unprecedented cycle. It's been the most elongated cycle in multifamily history. It has been incredible. And then we saw that fall off and have had some very muted rent growth at best and a lot of supply in the market the last 2 years. We can certainly see with the analytics that we utilize, when that absorption and that overhang of supply subsides and a rebalancing of demand will be in the marketplace in any given submarket or metro. That said, today's opportunity is buying basis, buying below replacement cost in anticipation of normalized and more robust rent growth due to a lack of supply. Noting that starts are down 80% over the last 2 years. Certainly, we've also had unprecedented absorption in the multifamily space, kind of along with that supply. So obviously, we're bullish for those reasons. We believe that later in 26, we'll start to see some of this happening, and moving on through the end of the decade, another upcycle for that industry. So it's exciting, but I think looking at the data is the key to this, not listening to somebody talk about it like me, but looking at the information to back up those observations. On the self-storage side, it's a bit different of a story. Self-storage rent growth and income growth is energized by single-family home sales and single-family building. And obviously, it is below the norm right now. I think everybody wants to hold on to their 3% mortgage before they make a move. But anyways, it is also an opportunistic time. Just like buying securities when there's a dip, buying real estate in the dip is also a key factor in value growth and realizing significant returns upon sale. Today, self-storage can be purchased below replacement cost, even newly delivered product. So I think there is a unique opportunity here that will result in significant yields 2, 3, 4 years down the road. Don't want to belabor it, but that's the observation on that. I want to turn it over, if I can, to the other guys to talk about this. Steve, do you want to weigh in first?
Yeah, I'm going to make it even a bigger discussion. I'm going to talk about, we talk about technology. I'm a big macro player at the end of the day. Here's what I know. AI scares the heck out of me, right? I don't have any idea of what it's going to displace or not. I know chat has become one of my best friends, right? So when you look at that, right, you say, okay, I got to guess. Like, yeah, and if you don't think it's had an effect, we know it's had an effect on office buildings. We know it's had an effect on retail, right? It's had a major effect. Like, you can't avoid that, right? So I look at that and I say, okay, here's what I know. I know that when you go to sleep at night, no matter how big your computer is, and I don't camp, right? You can't sleep under your computer, right? If you can do it at night, God bless you, right? But you need shelter. And so every night when you go to sleep, you need shelter. We know as a fact, on a macro trend basis, that America lacks housing in a very big way, a very big way. And it has only gotten worse because of high interest rates, costs of labor, costs of materials. It's made it even harder to build new and get more supply. So on a macro trend, and every market is different, right? And you got to really look at the market you're in, right? At the end of the day, we know that AI is not going to hurt it. It'll only help it by making it more efficient when you build it. At the end of the day, you need housing every night. So if I'm going to play something on a macro trend basis, I like housing.
Agreed. I would also point to the fact that the deficit that is out there is in the workforce housing or the missing middle, call it attainable housing. So while there's a great deal of Class A product built in this cycle run up, not so much on the missing middle. And there's significant opportunity there to fill that gap and truly create some amazing yields at the same time. We'll talk more about that in a moment. Todd, would you like to follow up Steve?
Yeah, well, I mean, I can see why Sterling is at the right place, right time now. I mean, and congratulations too on that, Lance, because right now in this space, as you know, self-storage, cash resilient. I mean, you know it's going to be there. Labor is low. People need to store items, and then you start thinking about the apartment complexes, and then really trying to group the real estate, the multifamily units that are there. There's demand for it. I mean, Steve touched on it. Very low demand, very low supply right now, high demand. It's secular, so you have to assume that this is not a play that's going to end up dying out very in the short term. So, because there doesn't appear to be a plan to increase supply of housing in this country at this point. And as long as rates remain, that instability of rates being higher, and then there's still no guarantee. I mean, I know since the Fed rate cut, we see rates dropping a little bit on the long end of the curve, but at the end of the day, it's not moving real estate at all. And that's why a lot of strategists like to talk about the fact that real estate is still an area they won't touch. They're not involved in the home builders or even thinking that that's going to be an area, sector that investors want to really pursue. However, that's on the stock side. From your standpoint, you're looking at going into the actual units themselves, and that makes a lot of sense. And that's why I think what Sterling is doing in the products that those offerings, that's the perfect time to be involved in that space.
Todd, you make a great point about the self-storage space. It is somewhat recession resistant and counter-cyclical. It works in both an upcycle and a down cycle. In this particular time period, it's a wonderful opportunity to buy stabilized assets, cash flow them, and wait for normalized growth for an exit upon sale, and especially if one is able to aggregate and get scale. So you're exactly right. Jeff, what's your perspective?
Yeah, I want to tie it back to the first question and actually follow up and ask you, Lance and Steve, a question related to this. But with the idea of democratization of assets and investment opportunities for more clients, and seeing that as the investment vehicle being utilized, typically in private and alternative investments, we might see a drawdown fund structure used. But with the rise of democratization, it's a shift towards a more perpetual and evergreen style investment vehicle. Do you think that the multifamily and self-storage space will be a beneficiary of that type of investment product? Thinking in the realm of not a forced liquidity over a specific time period in a drawdown fund, but rather a more perpetual hold type of investment. Do you think that these two sort of sub-asset classes within real estate can benefit from it, especially with such a large need for increasing the supply side?
Jeff, are you suggesting an evergreen format?
Yes.
Steve, you want to take that first?
No, but I will. That's a really good question.
Happy to. Here, I'll take it.
Yeah, and you can that's a great question, honestly.
It is.
Go ahead, Lance. I'll let you go first.
Yeah, I think that while I love the evergreen concept, as long as there are assets that are being sold at their highest value within the vehicle and new assets being added to maintain the income flow, I'm a big proponent of evergreen vehicles. There also has to be flexible redemption rights in those vehicles, and that's where it becomes challenging for the sponsor. And I hate to point out the challenging part of this, because the upside of this is a really nice income stream and great capital transactional IRR pops along the way. And so I've seen it successfully done. It's just extremely difficult to manage the cycle if there's a run on liquidity. And so that's the only thing I'll say from a warning standpoint. What I like is a longer hold fund that is committed to opportunistic exits. So what I mean by that is, instead of having a 3-year horizon, let's say it's a 5-year or even a 7-year, but the guidance is such that you may exit the fund earlier if you're at the part of the cycle where you can maximize value by selling earlier than the hold that has been given in guidance. Steve?
Yeah, so I'll tell you why it's such a good question. There is an evergreen, right? It's called a REIT, right? The public REITs are out there. They're evergreen already, right? The positive is you got an evergreen. The negative is they're very volatile, right? At the end of the day, and the volatility might have something to do with the underlying real estate. It might not. It might have to do with interest rates or some other third-party thing that occurred, right? So you kind of weigh the pros and the cons of having liquidity, evergreen, and volatility, right? And real estate really shouldn't be on a quarterly basis. I think, I'm not sure many public companies should be on a quarterly basis but they are today. I do believe, if we're going to have an evergreen, people do want liquidity. The retail investor wants liquidity at some point. And how you get that liquidity, there is no perfect methodology yet to get them what they want when they want it, knowing that real estate sometimes is a longer term play, right? And when they want liquidity, it's probably the worst time to give them liquidity. And so it wow, if I could figure out the perfect vehicle, and I'd love to spend hours on that of what that should look like, I would be all over it. But it's a hard one. It's a really hard one to get people exactly what they want in an illiquid asset.
If somebody wants that type of longevity, looking for a cash flowing vehicle that does have a great upside is really what they should be focused on. And in the alternative space, that is available. If it's a development opportunity, you're going to have a down period of no income. So, that's part of the evaluation process and really focuses on what your objectives are. Todd, do you have a comment on that?
I was just wondering about the tax situation. I mean, because this just bringing up about REITs is one thing, but I'm not investing, or I'm not having a private offering where I have to worry about taxable implications unless I sell that REIT. On the private side, it's a completely different story. So that's the only thing, and I'm sure it's state by state as well. So I don't know. I know there's a lot of considerations. I mean, and you go through this process with any investor where you have that conversation where you're talking about the longer term. You're thinking it's a long play. What is going to be the outcome at the end of that? Whereas with liquidity and the REIT, you can sell that day if you want. So I don't know. There's a lot of variables there. There's pros and cons. We start thinking of the on the evergreen side, but I don't know. It's a conversation I think that can that, like Steve said, it could go a couple of hours just trying to come up with this and trying to talk it through.
Well, a good tax advantaged alternative to that is the 1031 DST structure, in which you don't mind rolling that capital over and over again, and you're going to get a really nice coupon and some upside for the foreseeable future. So, again, you guys are right. We could spend all day on this. So at this point, I'm going to move on to the next question, but wonderful discussion, guys. Thank you. Okay, question 4, sponsor selection. What differentiates strong sponsors managers, and which KPIs or track records matter most for underwriting manager quality? I'd love to see. I'm gonna ask that Steve, you lead off with this one.
Okay. We always say sponsor, structure, strategy. 3 things you look at, right? And I go back and forth depending on when you get me and what's the most important. But strategy is usually my last, honestly. Sponsor and structure are usually my first 2. I think look, track record's everything. And it doesn't mean you shouldn't do a first time fund. Sometimes the first time funds are the best funds you ever do, right? But people have a track record. I always say, and this is where structure comes involved. I never loved school, but I remember Pavlov's dog: give people the right incentives, they do the right things, right? If the sponsor is motivated the correct way, and that is not to collect fees, but to create value, and the sponsor writes a check into the deal that's pari passu with you at a place that there's some pain, then I feel a little better about sponsors. I always say the person I don't want to back is 2 guys in a garage who are starting a business tomorrow, right? They want those fees. They live off those fees. They care for those fees. You'll never see your money back. They'll make those fees forever. And I think that a combination of a great sponsor with a track record and the right structure that creates alignment of interest and transparency is probably the way I'd go.
Very well said. I'd like to hear from an investor standpoint. And Jeff, you want to jump in?
Yeah, I'm happy to take part of this. I think, of course, track record matters. It's really important. I think the piece there to add is making sure you are benchmarking your potential manager appropriately. Because it's one thing to say, well, it doesn't look anything like public equity or private equity or this, debt strategy, but making sure that if you're looking at a real estate manager, you're benchmarking them appropriately within their sort of niche. And then back to what Steve said, the things that we care about on the real estate side is it's very macro driven. It's very cyclical. And we would expect a manager to know, kind of like you've talked about, Lance, a few times, you have your finger on the pulse of the market. You know what's going on, especially in your specialty, but also elsewhere. And getting us comfortable with that understanding is really a critical component there. Because track record, we can look at ourselves and we can kind of parse that through a number of different benchmarks and get a sense there, but we don't know your story and we don't know kind of where you specialize and why you are in the right place at the right time, and sort of what your right to win is what we talk about a lot. We need to understand that the manager is both in the right place at the right time, but also making the right decisions at the right time. And so evidence of that through case studies, deals, examples, opportunities, stories that can be proven is really a critical factor there, because you have to know what you're looking for and then find the right manager that's operating in that appropriate spot for you.
Yeah, Jeff's right. Jeff's right on that one. The benchmark is critical. I mean, you want to look at the manager's playbook in down markets. I mean, that's going to tell you more than any glossy marketing deck. So absolutely, that and transparency, two critical areas.
Yeah, I couldn't agree more. I mean, Jeff, you said it so well. What's the story? And just looking at due diligence and what's up on a website is just the start of that discussion and that evaluation. I of course, as a practitioner, as a sponsor, I get asked many questions, and some that are very rudimentary, some that are very penetrating. And obviously, as we get closer to a family office or senior leadership at an advisory firm, those questions become more specific and are very good. But regardless, what I see a lot of is, how long have you been in business? We enjoy an advantage because we'll be 50 years in February. What's your worst deal you ever did? And if that's not on your track record and you're not prepared to talk about it, that's a problem.
Yeah.
What's your best deal? And if you try and say, oh, I did a wonderful job and I provided an 8 times or 11 times, and don't say it because cap rate compression helped me, you are misleading, the person you're talking to. So, the story about the investment and the story about the sponsor is critical. The other thing I'll say about this that's very important is, what aspects of the investment is the sponsor controlling? Mm-hmm. If they are, it doesn't mean that if they're a pure manager that they should be avoided. That's not what I'm trying to say. But if they are vertically integrated, if they do have responsibility for other aspects of the execution and the track record has been positive, that is a plus. That helps reduce the risk profile of the outcome of that investment. Not everybody does that, and nor is it one-stop shop every time. We try and control as much as we can of the uncontrollables. And I think it's paid off over the years, although it is laborious. So,
Lance, one of my favorite questions related to your comment on asking about mistakes is asking a sponsor or manager like yourself, what deal is your biggest regret? Whether that's one that's in your portfolio or one that you missed out on, and understanding why that happened. Were you too slow in diligence? Were you not comfortable with the metrics? Did you not get along with the seller? Is there something that you missed because it was early in your career and you didn't know to look for that? And just understanding the learnings from that, I think, sheds a really important light on sort of the manager's approach to those investment opportunities.
Couldn't agree more, Jeff. That's a wonderful observation. And I think we all, I can recite those kind of immediately. And I'm asked that question more often than one would think. And really what it has to do is gives them a trail of my experience or our company's experience. Steve, you probably asked those same questions about the firms that you represent. Do you want to touch on that?
Yeah, I actually focus. I think some of people's best deals are the ones that they had the least returns on. Right. I used to say to people who work for me, I run trading operations. You know, if you've killed it and the whole market killed it, was it you or the market? Right. But when the market's really bad, if you've outperformed that, now that's impressive to me, right? So if you take some of the people's worst things and they can get positive returns in some very bad times where the market's going against them, now that's impressive, right? That's what I always say. That's when you really have to work. Um, right? People who invested in the stock market for a very long time, you could have thrown a dart against the wall and not lost. Is it that impressive? I'm not sure, but play through these volatile markets now and tell me how you come out, and I'll tell you how good you are.
And you said it earlier, Steve, if a sponsor is co-investing, that's a big, big plus. And really, somebody like me, I co-invest on everything we touch for a very specific reason. I want to have aligned interest. And when there is a bump in the road, that's when you discover what type of a vehicle you're in, what type of sponsorship you have, because how they conduct themselves is critical when there is a bump in the road. Guys,
I'm going to just tell you I'm going to tell you a crazy
Steve.
story about that. So I had 10,000 people working for me at one point, right? And the firm I was with, one of the firms I was with at the time, gave people the ability to invest $25,000 in deals. Now these people made fortunes, right? This is at the height of what Wall Street was. Now you would think that they would worry about what they were getting paid at the end of the year, but they were more worried about that $25,000 check that they wrote than the money they get paid at the end of the year. It just tells you the mentality of a person when they write a check, what it means to them.
Yeah,
and I think that is the key to everything.
Let's move on, guys. We have one more question, and then hopefully we'll have time for Q&A. Thank you for that wonderful discussion. Regulatory shifts. How could developments, i.e. 401k, inclusion, SEC updates, influence access, product design, and investor protections over the next 12 to 24 months? Steve, you want to lead off?
Sure. This is a good and bad. The good is there are people that probably should do other things with their 401ks, et cetera, their Roths, et cetera, that they're not doing because there have been these restrictions for a very long time. And there are people that should absolutely not do any more than they've done before because it's the wrong investment for them. And I do believe having a good financial advisor who walks you through your wants and needs, the risk you're taking or willing to take, is very important. I always say people who say they're risk takers in the world means if I'm making money, I'm a risk taker. When I lose money, I'm not a risk taker. People work very hard for their money. Middle class America every day works very hard for their money. They don't only have to be invested in the stock market and thinking that's the right answer. There are other ways to invest your money, but there's some more lack of liquidity. Be very careful. Understand what you're getting yourself into. Understand what you're buying. Understand all the risks you're taking. But having a diversified pool of stuff, I think, is better over time. But let's be very careful.
Todd, you want to follow that up?
Well, I mean, when it comes to an employer-sponsored plan, we're not talking about 100% of that portfolio is going to be permitted to be invested in these types of vehicles. I mean, there's no way that could happen because you have to look out and make sure someone is not going to damage themselves on their own. And that is Exhibit A. I mean, how that could happen. I mean, think of, you could take any type of the Enron, for example. People invested in Enron stock and they were left with nothing. So it's one thing to give that as an option. It's just another strategy, another aggressive strategy that's there. But if your portfolio makeup and your proximity to retirement isn't for decades alone, yeah, there's nothing wrong with these types of opportunities there for any type of individual that's in a deferred or tax deferred type of an account. So it's important to be able to offer those options, but there's also has to be safeguards there where the administrator is saying, okay, look, it's only going to be X amount of percent that you could possibly put into something like this just to protect yourself.
Absolutely. We've seen people utilize 401k and IRA for a long time. They do it through a trust company. So there has been ways to do that in the past, and we've seen it done very responsibly, and we've seen it done irresponsibly. And the guidance we've given is don't borrow against your 401k to do this. You're well, I'm not going to go off on that tangent, but this is just going to accelerate that. And furthermore, with people like BlackRock and KKR getting in that business and seeking those dollars, it's going to create even more confusion out there, because they see it as a huge, huge amount of money sitting there that can be put to work. Jeff, what's your thoughts?
Yeah, I mean, this ties in, I think, to our entire conversation so far, right? This is 401k, ERISA money is a somewhat untapped pool of capital that large firms who have the infrastructure in place to launch evergreen style funds or interval funds are going to be building products to access that capital and provide access to investors. And I think it's going to completely change the landscape. We're going to see more deals done in different manners. There's going to be a push for more deals to be done with less price sensitivity. They're going to have an excess pool of capital that has not been touched and not been deployed that's going to want to put money to work. And I think that it presents a lot of risks for both investors who are wanting to invest here, but also sponsors that may be beneficiaries or harmed by sort of the rise in supply on the capital side. It's really interesting, I think, with providing this access to more investors, potentially, not necessarily, but potentially less sophisticated investors. It goes to the point that was made earlier that hopefully those investors have really high quality advisors that know how to tell the story and how to explain to them the illiquidity side of this. But one of the things I think is really interesting is the majority, from my perspective, of investors in 401k plans, they are going to be taking the easy route, right? And that's why we had target date funds created a number of years ago to provide a diversified portfolio for someone to have a single line item that will move and adjust their allocation over time as they near a set retirement date or year. And I think we've seen this, the data shows us that the inclusion of alternatives improves a portfolio construction, both its returns and its volatility or standard deviation. And to the extent that alternatives are included within these sort of target date funds that are managed by very large institutions with great track records, good infrastructure, that could be beneficial. But the piece there is going to change the landscape for what the investment actually looks like, because as you noted earlier, Lance, the portfolio construction within an evergreen fund or an interval fund is going to look different because you maybe don't have the ability to wait on a development. You're going to have to go and acquire an already built and take in that income, which it can be a great source of return for investors. But it's going to change the return profile, and just there's so many layers to this, right? It's going to change everything as this sort of expands and makes its way across the market.
Well,
can I just point one thing out?
Sure, Steve.
Can I just point one thing out? When you say interval funds, people go, "Oh, I have liquidity. It's an interval fund, right?" Let's all be very careful there. It's a limited liquidity, and it can be gated, right?
Right.
So even when you buy, I always say, let's not get sold on the wrapper. Let's understand what's in the wrapper. If it's an illiquid asset in the wrapper, you can't create a wrapper that's just liquid all the time. So I think we all have to be careful what we buy and how we get our liquidity and what's in the wrapper at the end of the day.
The other thing I would add is Jeff, you pointed out these large vehicles that are forming and the opportunity that's there to access that capital is great. I think one thing that we haven't touched on is looking very hard at the fee structure within these vehicles. Definitely take the time to evaluate that. The bigger the offering, the bigger, more laden it's going to be with fees, and it's all across the board. And I think Todd and Jeff can probably speak to that very well.
Yeah, definitely. And to add to that too, just as a side note, imagine the employers here. I mean, there's only probably a few out there, a small part of the entire universe of S&P 500 companies that would actually permit these types of investments for their employees anyway. I mean, you're not going to have retail operations being able to offer this. Plus, you talk about those higher fees. Oh my goodness! I mean, it just cuts in. I mean, can you imagine those conversations internally? I mean, it would take. You're starting to hit a total return numbers for retirement accounts. Doesn't look good.
Mm-hmm.
Well, and let's stay there. You brought up a great question before, which is, just because you invest with big people doesn't mean the risk reward that you're getting net of fees is the right answer. There's a lot of cash out there looking for big deals. And if you look at the returns of some of the biggest players in this marketplace on a risk reward basis, it ain't that great. Yeah. So at the end of the day, you also got to look at where the opportunities, and Lance, and I think this is where you play and I play. At the end of the day, the opportunity that I see lays is with a place where the capital is not as available, right? That people aren't just throwing it at it. It's the middle market. It's the middle market play here that I believe has better risk return stuff than the bigger deals. And so when you look at it, ask yourself the question, if I'm buying an asset, do I really want to only get 8% on a real estate deal? At the end of the day, that's my total return versus getting 5 or 4 and change in, with no risk. Is that really worth the risk I'm taking and the illiquidity that I'm really taking? So I think you got to ask yourself, what am I getting paid for? And is it enough to get paid to take those risks and that illiquidity?
Right.
Excellent point. Guys, we could go on this tangent, I think, for a long time. We're coming to the end of the hour, and I just want to make time for maybe one question. There were a series of questions that were in the chat box, and I'm going to pick on one, and I think the perspective that Todd and Jeff have is going to be important. What do you see as the effects of private debt on present investments? And I think we all know kind of where they're going with this. Todd, do you want to take a shot at that one?
The private debt, I mean, this definitely seems to be the theme of the month. I'm hearing this quite often. So on present investments just goes to show, and I think Steve brought this up earlier, is that trying to find opportunities that are there. And you have to continue that competition that's there, what type of offerings that are there. So this private debt that's coming in can be quite dangerous. I mean, I hate to say it, but it does give the feeling that we're approaching that. I don't want to use the word bubble, but it definitely I think it's a little bit dangerous. I think it's a warning sign. So I don't know what Jeff's thoughts are, but I'm not pleased with hearing that we're going to be starting to take private debt and look at these types of offerings.
Yeah, I agree with you entirely, Todd. I mean, just look at the where private debt came from, right? It came to fill a void that banks were no longer filling. And we continue to see more sort of restrictions and limitations on banks, and they're pulling back more and more and more from lending, and the capital that's available is flowing in there. And I think it can present unique opportunities for some that are capable of making those investments. But you're seeing it kind of hit every area of the market. And as bigger deals are done with bigger check sizes and bigger debt loads, they're also moving farther down market. So it's sort of permeating everywhere. And so to the extent that Todd's right and it is a bubble, it will be an impactful one if it bursts.
Definitely.
There's been such a pivot that they're now seeking credit to fill the bucket, and that credit's starting to deteriorate.
Mm-hmm.
Any parting words, Steve?
Yeah, when you deal with debt, private debt, I'd also ask yourself, how are they valued, right? At the end of the day, you look at these interval funds and you look at debt portfolios they're valued in a different, they're not, if you try to liquidate your portfolio at that price, you probably couldn't. So, if you're looking at BDC, you probably can. So I think you got to ask yourself the question when you're buying private debt, it's a little, it's having its issues right now. What am I paying for it? What am I getting? There could be some opportunities if you do it right, and you could be well overpaying if you do it wrong.
Gentlemen, I'd like to thank you. It's been wonderful discussion, and I'm going to turn it over to Kyle for some parting remarks.
Great. Thank you so much. I just wanted to say a very special thank you to our amazing panelists for your great insights and being so generous with your time. was a very interesting discussion. On behalf of myself and Marcus Evans, I'd like to thank you also for the collaboration throughout. To turn things back to the audience, I'd like to thank you so much for joining us. I hope you enjoyed the discussion. There was lots of great questions and comments that came in. If we weren't able to get to all of them, we'll make sure to reach out to you afterwards. Just a reminder to look out for an email within the next 2 hours with links to review today's material, and we'd love your feedback about what you thought about the session today. The survey will pop up in just a moment. We'd really appreciate any comments that you might have. On behalf of the Sterling Group and Marcus Evans, I'd like to thank you so much for joining us and hope to see you again in a future event. Take care, everyone, and have a fantastic day.
Thank you to the panelists and thank you to the audience. Take care.
Thank you.